Hello, everyone. This is Brad Thomas, and welcome back to the Ground Up Podcast. Today, I've got another CEO interview, and I'm really excited today with this interview to have Sumit Roy, the CEO of Realty Income, with us today. Sumit, it's great to see you.
Very nice to see you as well, Brad. Thanks for having me.
Great. Well, one reason I'm excited is, of course, I've got a new book out right here, a little commercial, The Intelligent REIT Investor Guide. And this book, I'm sure you haven't read it yet, but what we do in this book is we help educate investors on how to pick the most intelligent REITs. And of course, it's no surprise that Realty Income is, in my book, one of the most intelligent REITs today. And of course, we're going to touch on a lot of this here on this call and why I believe so, and maybe you can help back up that story. But first and foremost, congratulations. This is the first time we've actually spoken since the really transformational news of Vereit, a merger that is expected to now close in the fourth quarter of 2021, has shareholder approval now. This will boost the combined company to a $50 billion enterprise value. It's the sixth largest REIT in the RMZ. So congratulations there, Sumit. And tell us, if you would, obviously there's a lot to chew on here with Vereit, but the things I wanted to really touch on are first the synergies and the opportunities to really create more accretion, not just day one, but I think one of the things that is missing from this story is the amount of debt that can be refinanced over time. So can you touch on that synergistic transaction with Vereit?
Yes, thank you for that. Yes, the transaction is, we use the same word, transformational for us, taking us to a completely different size and scale that we've all been aspiring towards, given how scalable our net lease business model is, as you know, Brad. The synergies we've talked about it is in this $35 to $45 million zip code, 75% of which we expect to realize within the very first 12 months of post-closing. And that is well on track. Currently, we find ourselves in the midst of trying to get the two companies integrated. As you might recall, August 12th, we had shareholder votes for the two respective companies. And there was overwhelming support. I think Vereit shareholders voted 99% plus in favor of this particular transaction, and our shareholders came in at well north of 98% in favor of this transaction. So, in a situation where oftentimes mergers and acquisitions are looked upon as winners and losers, this truly has been viewed as a win-win situation for both companies. So we are very proud of that. And our focus has primarily shifted now towards integrating the two companies and making sure that we are setting ourselves up to realize the synergies that we've talked about. And you raised a very important point. When we talk in terms of earnings accretion, we talk in terms of, day one, what is the expected outlook for the next 12 months? We oftentimes lose sight of additional levers of value that could potentially be there for this combined entity. And one of the main ones is the one you just referenced, Brad, around essentially taking their balance sheet and refinancing it with an A- A-rated credit. And the synergies that will translate to the value creation, the accretion that it will translate to in the future years, I think is something that often doesn't get spoken about. And that is clearly the case here. We have a higher rating than Vereit does, and our ability to access sources of capital, including the international markets, certainly will allow us to create value over the next 7, 8, 9 years that it'll take to essentially refinance this entire balance sheet. So, not only do we have year one value that will be realized, but we are looking forward to continued value creation through this combination for years to come.
Great. Well, another thing that I thought was really interesting, I want you to touch on, is the office portfolio. Now, as I've covered Realty Income over the last decade or so, I've always viewed I know Realty Income's office exposure was fairly modest in that you were acquiring properties that you may have already had a relationship with at the company. For example, Walgreens is a good example of that, where you had suburban office only tied to that because of the number of retail stores. Now, the plan currently is to take these office assets and spin those into, there's 97 properties there, $183 million in rent. Is that still the plan going forward? And will that potentially remove some potential overhang with that spin situation?
Yeah, since we are still in the midst of trying to spin the business off, etc., there's not much I can add to what's already out there in the public domain, Brad, outside of saying yes, both the spin and a potential sale is, our paths that we are pursuing. And regardless of which one of these particular paths eventually effectuate, we are shooting for a fourth quarter close. And I can report to you that we are along both those paths, and things are progressing as we had anticipated.
Well, there's been some interesting news, of course, right there in your backyard in San Diego. We've been covering and actually own shares in a little small REIT called City Office. And yesterday morning, a little announcement there, them selling off the San Diego portfolio, which created quite a buzz and about a 20% pop to the share price in that day. And also we've got, Sam Zell now in a bidding war on the Monmouth assets. So we're seeing a lot of activity in the market right now. And obviously these cap rates seem to be getting better and better. So that's only going to make things look better for the Realty Income business model. If we could, let's move over to Europe. I'm planning to go to Europe here, hopefully in October. While I'm there, I'm going to be visiting some of the properties that now I own, thanks to Realty Income. These grocery stores, Stansberry, which of course is a big player in Europe, I understand. $2.7 billion of exposure since May of 2019. So you've really kicked the European expansion into high gear. 83 properties currently as of the last deck in the second quarter. What about Europe? Are you still planning to kind of expand in Europe, and is that a big focus for the company?
It certainly is. If you recall, in the second quarter when we came out with our earnings announcement and we shared with you the acquisitions that we'd achieved, 50%, slightly north of 50%, and this was the first time it's ever happened, of our acquisitions were in the UK. And so, what started off as a modest addition to our acquisition strategy, where this was going to add another particular area of growth for us, and we were estimating it would be in the zip code of 10 to 20%, has far exceeded our expectations. And clearly you've shared some numbers that will attest to the statement I've just made. And the fact that, we always like to walk before we run, Brad, and this, you've been our shareholder for so many years. We like to understand what it is to go into a new situation. There are inherently new risks that we need to get comfortable with, some of which, and we hope most of which, we are able to anticipate before it actually occurs, so we can create the right guardrails. But some of it are brand new. And so thankfully, this particular expansion of our acquisition strategy has been quite successful. And, we feel very comfortable to now continue that particular model onto Western Europe. This is something we've talked about in public forums, in our earnings calls, that, our international strategy was not a UK-based strategy. Yes, UK was the geography that we had identified as the first, especially given the kind of products we were looking for and what we were able to facilitate through that first sale leaseback that we did with Sainsbury's. But now we are very comfortable. We've developed the muscle memory required to be successful in UK, and we want to take that model and basically replicate it. So yes, don't be surprised if we continue the expansion into Western Europe.
Great. Well, if we could, let's move to one of my favorite topics, which of course is the balance sheet. You mentioned A rating, fortress balance sheet there. What's interesting is since we've covered Realty Income over the years, we've watched the indirect peer Prologis move to triple B plus to A rating. And then we went, I think it was 18, 19 months after that, Realty Income kind of followed in that path. Of course, now what I'm hoping, I'm sure you are too, that multiple moves in the same path is Prologis. So my question here is, with your cost of capital today, are you able to transact, in the industrial logistics space? Can you be competitive in logistics, either both in the U.S. or abroad, in terms of your cost of capital today?
Yeah, I believe we can, and we've shown that. If you look at what we were able to do in the first half of this year of 2.1 billion, quite a bit of that was industrial assets. And I think the testament to it is, yes, industrial assets are very expensive today, but our cost of capital has also continued to improve over the last 18 months since the midst of the pandemic. If you look at what we can do on the debt side of things, here in the US, our 10-year unsecured will probably be in that 1.92% zip code. But in UK, it's going to be 40, 50 basis points inside of that. We just did a UK green bond offering, and the all-in cost was 1.49%. And the weighted average term on that particular unsecured bonds, there were two tranches, was right north of 9%. In Europe, I would say that it is about 120 basis points inside of what we can do here in the US. So if you try to match fund, product with cap rates, you very quickly can see why our cost of capital and our rating, which is what's portable across the pond, has translated into a weighted average cost of capital that does allow us to pursue the best and best real estate. And that will continue to be part of our overall strategy. And there's no secret that industrial is something that we've identified, and we've continued to grow. And post this merger, in fact, our portion of the overall portfolio being industrial will go up by 300 to 400 basis points.
Great. One thing I want to touch on, Sumit, I know we talked about this maybe in the last call, certainly last year, when COVID was really at the bottom, and specifically your theater exposure. So now it looks like in your investor deck that upon completion of the Vereit deal, your two theater operators, they fall off that list, the top 10 list, correct? And so how does that diversification come into play with this merger and your ability to scale the business?
Yeah, and look, those were some of the advantages that we touched on when we first announced the transaction, that one of the lessons learned through the pandemic had been that, perhaps the theater business should not represent a 6% of our overall portfolio allocation. And what we did say was, but we don't want to sort of over-index to what the lessons are here during the pandemic, because during the last financial crisis, this was an industry that had done very well. But we did say that, where we ended up was it should be right around 3% of the overall allocation, and we'll be comfortable in that zip code. And again, because of who we are buying and their lack of investments in the theater business, post close, this allocation will come down. And we've got some statistics that we've shared in the deck that we put out in terms of what the pro forma company is going to look like. And that's going to be right around the targeted allocation that we had, which is a good thing. But let's talk about the theater industry, because one of the reasons that we pointed to that allowed us to increase our guidance and share with the market almost a 10-cent increase in the midpoint of our previous guidance to our new guidance was largely driven by the recovery of the theater industry. In the month of July, we had reported that we had collected almost 99% of the theater rents, which is a good thing. And again, very much correlated with the theaters opening, content going through the theaters, and as we had anticipated, doing really well, creating north of $100 million in box office. And you can't replicate that through a streaming only model. And I think that was our original hypothesis, which is why we kept staying true to our knitting. And I think the data is now starting to prove that that's the case. And as long as we don't have another major shutdown, which I don't anticipate, despite what we're seeing with the Delta variant, I do believe that the theater industry, long term, is an industry that's going to have a place.
Yeah. Of course, I'm going to remind the audience, I think Realty Income was only maybe two or three out of the entire net lease sector that did have positive earnings. And that's AFFO per share growth in 2020. Finally, let's touch on the dividend, Sumit, which is always important for me. And of course, your company is called the monthly dividend company, so I know it's important for the company. 26 years in a row. So now you're more than halfway to becoming a dividend king, which is, of course, a 50-year record. How do you feel about it today in terms of your payout ratio? Kind of moving now closer into this transaction with Vereit. How do you feel about your dividend today?
Look, our dividend is what drives every part of our business. That singular focus on our mission statement of being the monthly dividend company that grows the dividend over time. That's a mantra that we try to live up to every day. On August 17th, we declared our 614th consecutive monthly dividend. We are part of the S&P 500 Dividend Aristocrats Index. And like you mentioned, it's a testament to having grown our dividend 26, 27 years. And we are only 3 REITs in a very exclusive list of 65 overall companies in this. And these are things that, it's not something that we want to feel prideful about, but it is something that guides our philosophy about how we want to run our business. Being this conservative real estate business that has a very long-term view and perspective on how to invest, takes a macro as well as a micro view on investments. I think that's what gives us confidence that this is, that staying singularly focused on the dividend is very important to us, and it's sacrosanct to how we think about, optimizing our balance sheet, et cetera, et cetera. In terms of our payout ratio, we continue to create more, safety in terms of, keeping it in that 80%, 79% zip code. And that again gives us the ability to withstand certain downturns in the economy like last year. And not once did we ever feel like, and I think you and I might have even spoken, Brad, hey, are you going to continue to pay your dividend? Of course we were going to do that. And it's a testament to how we had devised the overall portfolio and how we continue to perform. And just like you said, we still grew the business 2% in 2020. And it's part of how we think about the philosophy of running our business, and dividend is central to that. Yeah.
Well, it's a good feeling. I remember as a developer getting rent checks in the mail from Family Dollar and CVS, and I was really excited. Of course, then I had expenses to pay. These weren't net leases, a lot of these, especially Family Dollar. So that thrill would kind of be a little bit dilutive as I had to pay for toilets and roof leaks or whatever. So now the feeling of getting 10,000 rent checks in the mail every single month via a dividend check from Realty Income, because if you really think about it, that's what I'm getting. I'm now getting 10,000 rent checks coming in, because that's how many properties. Actually, I think it's over that, 10,000. And let me be precise. I'll go to your filing. It was over 10,300 rent checks coming in every month, which powers this monthly dividend. So. And I don't have to worry about the three T's, the toilets, the trash, and the taxes. So that's a really big thrill to get that check every single month.
No, thank you, Brad. And just to be clear, it's not 10,300 properties yet. It will be.
Yeah, exactly. Fourth quarter, we're looking forward to that. Thank you for that clarification. And Sumit, listen, thank you again for your time. Congratulations. I'm looking forward to catching up with you when you're a $50 billion enterprise REIT and the 6th largest in the RMZ. So really exciting news for you and the company as well as us shareholders. So thank you very much again.
It's my pleasure, Brad, and thank you for being a shareholder. We really appreciate it.
You bet.
Take care.